Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. The debt ceiling talks continue, and a strong start for the Q2 earnings season. That's what's on the docket for this edition of the Roundtable with our editor-at-large, Steve Reitmeister, Research Director Shiraz Mian, and market technician Kevin Matris. Unfortunately, those debt ceiling talks do continue. Looks like they hit an impasse over this past weekend. Unfortunate, though, that this impasse comes during a week where the market is already a little bit nervous over Friday's GDP numbers that are expected out as well. What do you think?
I think that we are seeing, Washington, sausage making at its worst, or at its worst or its finest. Right. It all depends on how you take a look at it. But this is, high theater, and I'm going to pull out the quote from Winston Churchill, which is, "America can always be counted on to do the right thing after they've explored every other option." Okay, and that's kind of where we're at right now. So we're hearing the two sides wrangling. They have so many even little deals they can pull off just to make sure that we do not have a disastrous situation on our hands. It's just a shame that I don't think we're going to get the substantial deal that most Americans want.
Right. But we will get a raise in the debt ceiling.
I imagine that, but here again, it's easy to say, let's just spend more money. Okay, that's been our problem for decades and decades. I mean, we want to. I think every American wants to see us rein in our debt to get our physical house in order the way we expect each individual to get their physical house in order. It's just that we may not see that until the next election cycle.
Sure, as this is a global market concern as well, not just a U.S. market concern. Are the markets running out of patience?
I think the market is basically shrugging the whole thing. If you look at the one asset class that would be directly hit by a U.S. default, which is the largest market in the world, the U.S. Treasuries, they just don't seem to care. It's inconceivable to imagine that they are complacent in the face of such a danger. Mm-hmm. I think the market is pricing in some sort of a deal which at a minimum raises the debt ceiling, and I think that's the right thing to do for the market. As Steve mentioned last week, we can't really find, short of gold, any asset class that seems to be concerned about it. And that is, in my view, the rational approach to look at this problem.
Yeah. Kevin, you agree?
Well, I mean, I understand the politics, I understand the brinksmanship, but, this debate is both embarrassing and dangerous. And as Steve said, I do believe that there is going to be a deal. But my fear is that it is not going to be substantial enough, and the credit rating agencies still may lower our rating anyways, and that is really the biggest boogeyman out there. And I'm always bullish and everything, but that is something that I'm growing increasingly more concerned about.
Yeah, what about that, Shiraz? What if we do get a deal, but we get a lower credit rating anyway?
This could be, if the credit ratings actually do, this would be a kind of their way to really kind of show that they are men enough. If that's the right way to put it, that they could really do their job as independently as all of us have been saying they don't do. But a credit rating is essentially relative to something else. Right. Now, if the U.S. credit rating is lowered, that's relative to what is it bad? Mm-hmm. Short of China, short of Taiwan and Hong Kong, we don't really see pristine balance sheets anywhere else in the world either. Right. So the U.S. may be in a tougher spot, right, but so is everybody else. And still, the lesser of the better, if there is such a thing, balance sheets, I think we still have a good shot at maintaining the AAA.
Yeah, right. The best looking horse at the glue factory.
Right. That's right.
Okay, that's right. And from that, horse derby right there.
That's a very interesting way of putting it.
That everyone already knows. The physical condition of the United States. A ratings change would not change the mind of the fund managers who put billions and billions of dollars into this. It would be one of the biggest non-events that we've seen this year.
But while it is still the best and safest game in town, that isn't going to preclude interest rates from ratcheting up, and that could have a negative impact on the economy. So there will be some ramifications.
Let's talk about earnings season because we're running out of time. Shiraz, another big week for earnings this week. A lot of reports coming out. You're happy so far with the way things are going?
I'm very happy. We have about a third of the earnings reports out, and it's looking as good as we have been seeing in recent quarters. This is, in fact, the end of Q2 was the 8th quarter or the completion of 2 years after we came out of the recession. So there has been some concern that the earnings growth is going to taper off. We're not seeing that. Yes, margins are expanding less than we had seen in the prior quarters, but that's been more than compensated for by top line gains. So yes, it's a very solid earnings season.
Yeah. Steve, if we didn't have all this other noise going on around us, would the market be responding better to Q2 earnings season than it is?
Well, if you think about it, it has responded well, but there's just no, I mean, we've pushed up to very close to the highs of the year, say call it, Dow 12,800. We have pushed up very close to that level with this debt ceiling and financial Armageddon, which is not going to happen, being talked about in the media. So we just can't get beyond it until that story is settled. But very clearly, people are responding well to earnings season, and I think that if we get the debt ceiling off the table here in the next week, and we just table it to for 6, 12, 18 months down the road, that I think the market will spring to 13,000 like that.
Kevin, you're happy with earnings season?
Well, analysts are increasing their earnings estimates for the next quarter, so I'm happy with the way things are progressing, yeah.
Okay, well, give us your top stock pick.
Mine is AAR Corp, ticker AIR. They're in the aerospace defense industry, and they're a worldwide leader in supplying aerospace, aviation parts, and this kind of thing. They have a Zacks rank of a 2, which is a buy, 20% growth rate, very low valuations. Earnings estimates continue to be ratcheted up across the board, which is actually not surprising because the industry is really doing fantastic right now. They are on the move. I have a price target of $35 on this one for a 24% increase from here.
Shiraz.
Kansas City Southern, a railroad operator. It's a play both on the economy as well as secular trends. The high fuel costs benefits them because it puts them in a better advantage relative to other transportation modes. The improving export performance of U.S. goods and commodities is also a play in Kansas City Southern. So it's overall a solid play both from secular as well as cyclical reasons.
Okay, Steve.
Apple, yes, shares are up 25% this year, and yes, the shares are nowhere near fair value. Given another earnings blowout, people are looking at about $31, $32 in earnings next year. This stock should at least have a PE of 15. I'm sorry, there's just no other way to look at it for as explosive earnings are. If I do that, that makes the shares worth $480. Oh, but wait!
There's more.
They have $80 in cash per share. So the shares are worth $560 even with the most reasonable and conservative and modest valuation. And that is why I won't stop talking about Apple until it gets to the price it deserves.
You look like you had to convince Kevin a little bit.
He likes it too, trust me.
We had some disagreements over Apple, but we have rested our case.
Oh, okay.
Because I have won the disagreement.
No disagreement here.
You're all good. Thanks for joining us. Thank you for joining us as well. Hope the week ahead is a profitable one for you.